Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Kansas City, Missouri. Welcome to the show, Bob Fraser.
Great to be here with you.
So, Bob, you've been in a couple of different industries, like myself, started out in the tech industry. It's not a usual career path for most real estate investors. Why don't you give a little bit of your backstory and how you got to this point in your journey?
Yeah, sure. Well, I was a computer programmer, so computer scientist from Berkeley, and loved that, enjoyed that. Ended up starting a tech business in the late 90s that became a big deal and becoming one of the fastest growing businesses in the Midwest region of the United States. Hired 300 employees, raised $44 million in venture capital, and win the Ernst & Young Entrepreneur of the Year award. And then it blows up in the tech wreck. So, my boast is my crater is bigger than your crater. So we lost everything. Then a few years later, did another stock market venture and just timed that. Literally, we started September of 2008. So I have a gift of timing, I guess, and I lost everything there. And then came back and started in 2012, my current business, which is note investing and really getting into, did tech, did the stock market, and, real estate debt is just far less volatile. And so much safer, much more predictable outcomes, which is what I was going for, after getting creamed with forces outside my control. I would rather have forces inside my control.
Certainly difficult to predict the market, where if the success of your business is 100% reliant on market timing, then you're basically handing over control of your business to the market. And that's a dangerous thing to do.
And in fact, if you look at the stock market, it's very fad driven. I mean, when you have PE ratios that shift, what's the logic of that? The investor world is very faddish, very popular ideas of the time. And if somebody decides your stock is bad, it's sold off. It really is a lot of nonsense. As Warren Buffett said, if markets were efficient, I would be broke. So the truth is, there's a lot of opportunity. To me, you want to not have your price dependent on someone else's opinion.
That makes a lot of sense. Okay, so you've gone through a couple of economic cycles here. You went through the tech bust in around post-year 2000. You've gone through what many of us thought was going to be the dislocation of a lifetime in post-2008. And here we are a decade later on the cusp of maybe going through something as big or bigger. What are your thoughts on the economic outlook?
I'm actually very bullish on the economic outlook, pretty much in all flavors, including GDP and property prices. And of course, property prices are local, and so I'm not talking about maybe San Francisco or New York or a couple of these higher priced locales, but really on national averages, prices is single family homes especially look like they have room to run. And on several fundamental factors, for instance, they're quite low priced relative, for example, price to rent ratio or replacement cost. Adding to the fact of, low interest rates in the 3% range is insane. It's going to continue to pump cash into the markets. Markets have been fundamentally underbuilt for the last 15 years. So there's been very little new single family home development. And so there's a chronic shortage of supply and demand. So it's very different from the 2008 crisis. Very, very different. In 2006, 80% of new single-family originations had under a 700 FICO, 80%. Today, it's only 20%. It's very different. There's the same kind of speculation is not going on. And furthermore, when the Fed is printing money, you want to be in assets. Okay, so when there is massive easy money policy, and it's not just the Fed, it's the Bank of China, it's the ECB, it's the Bank of Japan, and the Fed. So when they're printing money, you want to be in assets.
And you want to be in assets because basically you're shorting you don't want to just be in assets, you want to be in leveraged assets because you're shorting the dollar and allowing that price appreciation to go to the equity side of the equation.
That's right. I mean, the theory was, I used to be a hard money guy. I kind of shifted my view in 2012 when I was expecting hyperinflation and didn't happen, and actually tracked, well, what did move? So I did a bunch of analysis and looked at how does money printing in the modern sense affect the markets. And the biggest change was to the stock market. The second biggest change was in real estate. So when the Fed is printing money, everybody's expecting inflation. And here's the key understanding is to divide inflation into two components. One is consumer price inflation, the other is asset price inflation, right? Now, consumer price inflation is what we think of as inflation, consumer prices. Well, that doesn't go up in a money printing scenario, okay, generally in modern money printing scenarios. But asset prices do go up, and we like that inflation, right? When the stock market goes up, when the price of your house goes up and your real estate investments, we love that kind of inflation. So as soon as you bifurcate it, all of a sudden it makes a lot of sense. When the Fed is printing money, you're releasing that money, then the value of that money is going down relative to other things. And today it's primarily going into asset prices versus consumer prices. So consumer prices are in a systemic declines. So if you look at the big three, wages, food, and energy, they're in systemic declines. Wages are in systemic declines due to automation, globalization, et cetera. Right? Food is in systemic declines because of productivity increases, and energy as well. Number one energy producer in the world today is the United States. What's that about? Well, with the new technologies it's just unleashed a wave of new product. And so all these things are in systemic declines. The bottom line, we're not going to see consumer price inflation, in my opinion, in the near term. And so without consumer price inflation going up, there's no reason for easy money policies to stop. So I see easy money policies continuing. Next crisis hits, guess what they're going to do? And when the next crisis hits, guess what they're going to do? And so every crisis is going to be met by money easing. And again, so assets are the place to be. You just want to be in assets. And as you pointed out, leveraged assets are even better than assets.
I love it. So today you're in the business of non-performing notes. We went through a cycle of that post-2008. How does the current environment compare today to the post-2008 environment?
Well, we had obviously the Great Recession where not much seemed to happen, the wonderful Obama years where we couldn't seem to get the economy moving. And then, of course, Trump comes in and passes his tax plan, which was really a wonderful thing. And all of a sudden, the economy started moving again. We are probably going to see another wave of defaults. The news in the Wall Street Journal this morning was the wave of evictions coming. Now, that's a little different. Rents, is a little different than mortgages, but probably correlated. We're probably going to see more defaults. In our experience, it's interesting. We're not really seeing that in our business. Increasing default rates, we're seeing slight increases, but really not significant. We don't really have a theory as to what's going on there, except that maybe people are more doing everything they can to keep their home, since that's where they're staying.
So when we talk about notes investing, there's many different ways to do that. You can be buying performing notes, you can be buying non-performing notes, you could be doing loan modifications and workout strategies, all kinds of different approaches. What do you think is appropriate at this point in 2020?
Yeah, well, we're doing both of those actually. We have a non-performing note strategy where we buy non-performing residential notes and we basically work to get them performing again. And we're very successful at that. That business is booming and we're doing better than we've ever done. So I can say with authority that that's still working. And then we have another side where we buy the reperforming notes and just hold them for income and, mailbox money. And that's working super well as well. It's kind of soaring through the COVID challenge here. Definitely a good time for both those strategies.
Post 2008, the non-performing note market seemed to have so much supply. People were buying non-performing notes for 30 cents on the dollar, 25 cents on the dollar. They were doing loan modifications at 50, 60 cents on the dollar and still making a very tidy profit, getting those modified loans reperforming.
And helping the borrowers. Yeah, that's right.
Right. There's a lot more money. There's a lot more institutional money now chasing these non-performing notes because they've noticed that there's money to be made there. Is it an auction environment? Have those deep discounts disappeared today?
No, we're still seeing the discounts. You actually saw on the senior liens, the prices kind of got bid up, into the above 60 cents in the dollar range, 60 cents really of home value versus UPB. And then the prices came back down as people realized they weren't making money doing that. I think prices are pretty stable right now in the 40 to 55 cent range. We focus on the second mortgage space, which is a much thinner market. It's, as my partner says, first mortgages, seniors are like checkers, financial checkers. Seconds are like financial chess. And so we're the chess masters buying this stuff and buying it far deeper discounts. And we're very, very, very selective in our underwriting, and our margins are far higher as well.
You've obviously got less competition because people perceive the entire space as much riskier.
Oh, yeah. People don't know what to do with seconds, including banks. They just don't know what to do with it. They won't foreclose on a second generally. A lot of people that buy the defaulted distressed debt buy the first and just they get the seconds for free and give them away, basically. So we love those. We do super well with the seconds. Again, it's much more complex workout process because you not only have to understand everything about the first, or the real, you got to understand the real estate, you got to understand the borrower, you got to understand the state and all that. You also have to understand the senior mortgage and have a pretty good visibility on that. And a lot of times you just don't have visibility. So that's the tricky part, but it gives you a lot of power too, because we have a lot of power to really help a borrower because we have such deep discounts. We control short sale. We can have a lot of principal we can wipe out because we have a lot of wiggle room with the seconds.
Now, of course, in the residential space, you're not likely to have intercreditor agreements between the first and the second. They don't know much about each other.
Oh, no.
Your situation is, I'm sure, one where if they're in default on the second, they're likely in default on the first as well.
Almost never. We only buy ones where they're not in default on the first. So we buy seconds where they're performing on the senior. So yeah, okay. And that's the secret sauce.
That's the key.
That's the secret sauce. Yeah. So the senior's being paid down. What's happening in my equity position over time, and then if you add the trajectory of the fair market value of the underlying home, well, all of a sudden these things just age phenomenally well. So where you buy them at X cents, they just age super well. So everything moves in our favor over time, and as long as that senior is being paid. With the second, when a performing senior, we actually know the home's occupied. We know the homeowner generally is trying to keep their home. So all those things make it, kind of eliminate some pretty major risk factors. A home that doesn't exist or hasn't been kept up or is vacant for 5 years or something. It's just incredibly expensive and difficult to overcome. So we deal with none of that. Ours, it's kind of a financial play more than a real estate play. So we're primarily talking to the borrowers. Probably 2/3 of our outcomes are loan modifications. So we come up with an affordable loan modification. About 25% of our outcomes are settlements. So we say, hey, you owe $100,000. Why don't you write us a check for $25,000 and wipe it out? Literally shows in your credit report paid in full. Well, that's a good phone call to get, right? And we can really help change people's lives, which we like. We only foreclose about 1.5% of the time. And that's pretty much when they're not working with us. So we're able to really take some bad paper and really help people and turn it into good paper and good outcomes.
And does it make a difference to you whether those seconds are lines of credit or amortized loans? Does it make a difference?
Not at all.
Fantastic. Well, Bob, if folks want to connect, if they want to learn more, what's the best way?
AspenFunds, FUNDS.US. AspenFunds.us.
Fascinating discussion. So thank you for the insights, and for the listeners at home, definitely reach out to Bob Fraser at aspenfunds.us. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.